So two reasons, in my opinion, why big tech has roared back. And it has nothing to do with Tom Lee just stated there, in my personal opinion, okay? The two reasons are this. One is almost all those companies are cutting employees. And many of those employees are people that make a lot of money. Let's call it between all the different compensation, a lot of those employees make $200,000, $300,000, $400,000. When you add it up upon thousands or even tens of thousands of jobs being cut, it's an immense amount of profitability those companies are going to basically see come through over this next 1 to 2 years. Okay, and obviously that's long term. So those companies really watching their pockets. Let's call it that. Okay. The second reason why those stocks have come back so strong is almost all of them got massively oversold to ridiculous levels. Should Meta have gone down to below $90? No. Should Tesla went down to $100? No. Should Shopify went down to $25? No. You go through all those stocks. Should AMD went to $55? No. Should Nvidia went to $110? No. Okay, so you can go through all those stocks. They got way oversold. Should those stocks have sold off at least a little bit? Yes. They also should have sold off between 30 and 50%, all those stocks. But the problem is many of those stocks sold off between 50 and 80%. And you're talking about that's a substantial difference. And when you're talking about going through a vicious market like we went through in 2022 where the NASDAQ fell at the peak, it was down like 37%, right? You're going to have some stocks that get massively oversold. And that's what we saw. And now it's kind of like a rally back from like where those stocks should be trading. Metastock, I think Metastock deserved to go down to $180, $190, $200. But down to $80? No. Did Tesla deserve to come down to the $200 level or $150? Sure. Did it deserve to go to $100? No, that was way oversold. And so I think that's an important factor there. Now, I don't know if you guys saw this top news. Google McDougal is going to cut down on employee laptops and services and staplers and all this stuff to save money, right? And they already announced they're doing big employee cuts, right? In the story with Google McDougal, is a story with the stock market in general in 2023, in my opinion. It really started in 2022, right? I think this is just the kind of grand finale year. Every single business out there is watching their costs. Now, that hurts the economy, that hurts spending, that hurts the business climate in the short term. But I can tell you what's going to emerge in 2024, actually got to start this year, but really in 2024 as far as a full year, 2025 and future years, is companies that are in far better, and I mean far better, let's call it business models, cost with their business, margins, like everything you're going to see is going to improve quite dramatically in these companies. And I think it's going to make for a nice 5-year run where these companies are going to be able to expand their bottom lines at a much faster clip than their top lines are expanding. Basically meaning if a company has, let's say their revenues go up 10%, or let's say their revenues go up 5%, I believe a lot of these companies' net incomes could go up 8%, 10%, 12%, okay, and far outstrip their revenue growth. And that's something that happened coming out of 2009, because companies in 2008, 2009 did obviously a ton of employee cuts, and obviously they cut costs in their business, and they learned how to run their business much more efficient. And what you saw is unbelievable net income growth from companies from all the way starting in the back half of 2009 all the way through the back half of 2014. And if you see the net income growth of an average company, it was extraordinary during that time. And I think we're going to set up for the back half of 2023 all the way through to about, let's call it 2026, if not 2027, incredible net income growth with companies that's going to far outstrip revenue growth, which is something we haven't really seen in a while. Because if anything, we've been seeing companies have stronger revenue growth than bottom line growth, which is actually usually not a very healthy sign for companies. Always do keep in mind, a healthier sign for companies is a situation where the bottom line outstrips the top line, okay? That's the ideal situation. And so just understand when you see stuff like this, it hurts short term, but I can tell you this is going to make so many of these public companies, almost all of them, such better companies for the next 4 or 5 years, folks. And for that, it's something to be very bullish about over the next number of years. If you are an investor in the market, which you more likely, if you're watching this video, you're an investor in the market, right? You're an investor into stocks. Maybe you're in index funds. Maybe you're into individual stocks. If you watch my content, you're probably more into individual stocks, right? Maybe you're into crypto, things like that. What most folks don't pay attention to is certainly the bond market. And you heard Tom Lee just talk about the, basically kind of like the VIX for the bond market is basically screaming like the VIX for stocks if it was at like a 50, let's say, for instance, right, which is insanely high. And you heard Kathy Wood, we did a reaction to Kathy Wood. One of the things that Kathy Wood talked about on yesterday's video on this channel, right, was bond investors had the worst year they've had in like 200 years, she gave an example, right, which is absolutely insane to even think about. And so, nonetheless, we definitely had a tough, let's just call it a tough, brutal 2022 for us that are in stocks, right? But I can tell you, bond investors potentially got it even worse than us, which is kind of almost shocking to think about, right? But that's the sort of stuff you're going to see when you have the Fed completely change trajectory from like, Fed funds rate of 0 to like we're skyrocketing interest rates. You're going to see that sort of collateral damage, right? And you're seeing some of that play out obviously in the banking system. Tom Lee's here is talking about some potential panic, that could come into the market, right? If more panic comes in the market, I can tell you that's not bullish for equities, at least in the short term. That's bearish short term. So, but Tom Lee always has a way to twist almost everything, bullish. And I've gave this example on a Tom Lee video before, right? To be a bull in the market, you don't have to take Tom Lee's stance in terms of thinking everything means market up in the short term, right? And, I'm always bullish on the market for the long term, right? Short term, you're going to have to deal with what you're going to have to deal with in the short term. But you can easily be a bull over the long term and believe stocks are going up over the next 3 years, 5 years, 7 years, right? And take advantage of deals out there in the market without having to go to the Tom Lee extent of like somehow always something bad is good, always everything means stocks up short term, because that seems like it's almost always the position that Tom Lee takes, and it's just kind of like, come on, man. Like, we don't need to take that position, right? Take the position of being a long, take advantage of deals in the market if those deals are presented to you, right? If stocks go down big and you got a bunch of deals out there, take advantage of those deals. You don't have to believe that the stock market is going to go up over the next 3 to 6 months to believe the stock market is going to go up the next 3 to 6 years, okay? And so there's a divergence in bulls, and we gotta separate those, and I think that's very important for everybody to understand, even whether you're newer to the market or you've been in this market a while. For Carvana shareholders, like this is viable option. It's either 0 or something, right? So would you rather have 0 or would you rather have something? For Carvana shareholders, they'd much rather have something than a 0 situation, bankruptcy, right? How many different options public companies really have at their disposal to get themselves to hopefully a day on the brighter side, right? Which is profitability, which is a company actually being a viable, real company, meaning they make profits. They actually, can stand on their own 2 feet. They don't need to constantly dilute shareholder value or constantly take out debt or do bond instruments. But there's so many different options out there. And so I think a lot of times people think like, it's just easy to put a company in bankruptcy and to go to 0. No. Is it very possible to get a stock to go down 70, 80, 90%? Yes. But that last 10 to 20% is vicious, okay? Let's say it was at a $10 stock. To get it to $2 or $1, possible. To get it to 0, very, very difficult. It's actually a much more difficult process than I think a lot of people realize. And you can see it because there's so many companies that are like what I call almost like zombie companies that stay afloat for a long, long time. It's like, how is that company still around? How are they still making it, right? JCPenney's was a good example of a company that, was always that company for me that I was like, how are they still around? Like, it was crazy.